Well, good morning, everybody, and thanks for joining us. We've got a full agenda this morning, so we're going to try to do our best here to get started on time and be respectful of your time and keep this to an hour. One thing we did want to let you know is we are going to do things a little bit differently than we have in the past to keep the background noise to nothing, not limited, but to nothing. We've muted the line, and we would encourage you to ask questions. You can see how you can ask questions here. If you pull your mouse to the bottom of your screen, you'll see that this little toolbar at the bottom or menu at the bottom of your screen will appear, and there's a chat icon there. If you just click on that chat icon, it's going to bring up a little dialog box, and if you'll go ahead and enter your question there, and hit enter, it will submit your question to us. We'll be the only ones that can see it, so it's an anonymous question. And we encourage you to ask them. We'll probably stop at a couple times throughout the presentation if there are questions, just to go through them. And again, we'd like for this to be a dialogue and a discussion with you more than a presentation. So if you do have anything on your mind, frankly, whether it's regarding what we're presenting or just something else that's on your mind in general that maybe we haven't discussed, we welcome you the opportunity for you to ask questions. Real quickly, just some quick background here, just disclosures to make sure that everybody understands. We're going to be talking about performance, both past performance as well as maybe some future expectations on performance. Want to make sure people understand past performance is not a guarantee of future results. If you do have any questions on performance after the meeting, you're welcome to get in contact with us. So real quickly here on the team, those of you that are clients received an email from us that we've recently added a new member to our team. You can see here myself, this is Mike, Matt in the middle, and then Rachel. And this year we just added a new advisor to the team about a month ago. We're super excited to have Katie join us as the business grows and as our clients refer friends and family members to us. First of all, we're very thankful of that, but Katie now gives us a little bit more manpower to be able to support advising new clients. Katie comes to us with about a decade background in advising clients on the banking side, and I wanted to introduce you to Katie and give her just a minute to tell you a little bit more about her background.
Well, good morning, everybody. It's such a pleasure to be here with all of you. Some of you I've actually had the pleasure of meeting either face-to-face or over the phone, and others I'm really looking forward to having that opportunity here in the next few weeks and over the next few months. So like Mike said, my name's Katie Dow. Just to give you my brief kind of history and background, I'm a Montana girl. I grew up on the High Line in Montana, up in a small town, northeastern Montana. If any of you are familiar with Montana, you'll be thinking right now that, oh, I bet she was super cold growing up. And that's true. In fact, earlier this week, my parents woke up to 45 below zero temperatures. So I'm happy to be out of Glasgow and into Boise. I did play golf in at a small private school in Montana. And after I graduated, I moved to Dallas, Texas, where I started my decade-long banking career. So started at a really large bank in Dallas, Texas, a ground level, and worked my way up there. And it was a great experience for me because I kind of really got to know like the fundamentals of banking and intricacies of the big banking world. After a couple years in Dallas, I was recruited back to Montana, where I grew a division from 1 to 7 and 3 support staff. There I was advising clients, and we were really focused on lending and real estate transactions. Just as I got comfortable and in the groove, my CEO came to me and said, Katie, what you've done in Montana, we'd like you to do in Boise, Idaho. So they flew me out to Boise, and I opened 2 different branches in Boise as well, where I grew different teams, managed the teams, mentored different team members, and also advised clients and a large portfolio of clients. So I loved my job there, had a great time, but after a while I got a little weary of just kind of always selling the same products and those same products that were approved by the bank or were the bank's products itself. And I started getting interested in what else was out there and trying to align something with my own personal values and goals. And I found this independent fiduciary space, and I met Mike Mers. So after talking with him a little bit, getting to know the team here, Matt and Rachel, a little bit better, and everything that Aspen Capital Management was doing for their clients and offering, I decided to make the leap and started with the team here just after the first of the year. So I am super excited to be here. Again, a fiduciary space, somewhere that aligns with my own personal values, and really just looking forward to a long career here at Aspen Capital Management and working with all of you. So if you have any other questions or want to get to know me, I'd love to hear from you, take you out for coffee, or even play a round of golf. Okay, so we're going to get right to it. Our agenda today is a packed one. So like Mike said a little bit earlier, we're going to try to be really respectful of your time and move along quickly, but please feel free to ask any questions. First, there's 3 different segments of our conversation today. The first one is your portfolio performance and last year in review. We're going to really take a look at your asset class and the ACM fund performance, as well as long-term performance. Next is your investments, putting 2018 into context. So we're going to spend some time at really looking at what 2018 was like versus 2017. We're going to look at the volatility and try to put that into context for you. And we're going to answer what it actually means for you and your portfolio. And lastly, a little bit of time discussing healthcare and financial planning. Healthcare is on the rise as far as costs are considered, and planning for healthcare costs are really important. So we're going to take some time there and discuss that. So with that, let's get right to it in your portfolio performance last year in review. Matt, take it away.
All right, thank you, Katie. So we're going to take a peek at 2018 market performance across the different asset classes. And what you'll see on this chart at a high level is that globally diversified equities and real estate were all negative in 2018, which is certainly unique to have all of them negative in a calendar year. On the right there, you'll see bonds were dead flat. And as many of you know, there are 2 reasons why we hold a given position in our portfolio. One reason is to increase our long-term expected return, which is why we hold equities and real estate. And the other reason is to decrease the volatility of the portfolio, which is why we hold bonds. So if you take a look at last year, many of our clients did reap the diversification benefits of bonds in a year where everything else was by and large negative. Digging into the slide a little bit deeper, 2018 was a year in which domestic or US equities outperformed international and emerging market equities. Katie mentioned it a little bit, but throughout this webinar, we'll be talking about 2018 in context. And I think that's important to do because while we aren't going to shy away from the negative returns we experienced last year, it is important to remember back to years like 2017, when every single asset class in the entire world was positive, and specifically international equities, which you'll think of as countries like Western Europe, Japan, Australia, Canada, were all up over 28%, while emerging market equities, which are the BRICS countries, Brazil, Russia, India, China, South Africa, were up over 37%. So while it's never fun for any of us when these asset classes are negative like this across the board, it's important to remember the recent fantastic years we had prior to 2018. Now, if you were a disciplined investor in 2018, and certainly for some of us, it wasn't easy to be a disciplined investor, but if you were a disciplined investor in 2018, like most of our clients were, you would have realized the aggressive bounce back we've had so far in the first month of 2019 so far, with global equities regaining about half of last year's decline just this month. And this bounce back really highlights the near impossible nature of trying to time markets. When we see short-term volatility like we saw at the end of last year, investors tend to become emotional and make behavioral mistakes. In December of last year, investors pulled billions of dollars from equity funds and most of them have subsequently missed this positive performance we've experienced so far this year. You can see all of the asset classes we primarily use in our clients' globally diversified portfolios have had a great start to 2019, with US small caps leading the way at just under a 10% gain year to date. This data is as of 1/24, so it's last week's data. It's probably a little bit better than that, but you can see positive performance across the board there. And at the end of the day, we don't know what will happen the rest of 2019, but it has been great to see this quick recovery we've had in equity markets and real estate across the globe. So what we wanted to do on these next few slides, and many of you have seen these slides before, is just provide some context into how the funds we own in our portfolios have performed relative to their benchmark index funds over different time periods. And on this slide, the green numbers represent annualized outperformance for the funds we use, and the red numbers represent annualized underperformance. Now, as many of you know, when we invest in equities, we're targeting different premiums. We're targeting the small cap, the value, and profitability premiums. And we know these premiums aren't positive every single year, but we do tend to increase our expectation that they'll be positive the longer we have exposure to them. So the expectation is to have outperformance over the 10-year and longer term time periods, knowing that we will have periods of underperformance from time to time over the 1 year and even the 5-year time periods. And this is certainly what we've seen, with short-term performance lagging due to the value premium. Over the past 5 and 10-year periods, growth stocks have outperformed value stocks. Now you can see on this chart, the 10-year period, all of the funds we primarily use have outperformed their benchmark index funds. If you take a look at the far right column, it shows the percentage of all mutual funds within that respective asset class that were outperformed by their benchmarks over that previous 15-year period. Said differently, these are the percentage of funds that underperformed their benchmarks. So for example, you see there, of all US small cap funds, 97% of them were outperformed by their benchmark over the previous 15-year period. Similar to US equities, small cap stocks underperformed the rest of the world in 2018. However, over the 10-year and since inception periods, we've seen nice outperformance versus benchmark index funds. And as I had just mentioned, targeting the small cap, the value, and the profitability premiums, our expectation is to have outperformance over the longer term, knowing that we will have underperformance from time to time in the shorter term. If the premiums were positive every single year, the market would simply trade that advantage away. Lastly, moving on to bonds and globally diversified real estate. Bonds were flat last year due to rising interest rates. And remember, when interest rates rise, bond prices decline. So our total return last year, which is the combination of the interest payments the bonds make and price fluctuation due to declining interest rates, total return from bonds was flat for the year. On the global real estate side, you'll see exceptionally good returns and outperformance over the last decade, with returns just over 11% per year on an annualized basis.
So Matt gave you an idea of what shorter term performance has been over the 1, 5, and 10-year periods. What we wanted to give you an idea was how these funds compared over, say, the 15-year period, sort of the longest time period with which we can get pretty good data across global asset classes. And I know many of you have seen this chart before. We've shared this chart quite a bit over the last year. But we wanted to just walk you through it to give you an idea of how these premiums have performed over the last decade. So this is a little bit new information for some of you. It's through the end of the third quarter of last year. This is a really busy chart. So what we're going to do is we're going to start on the very left, and we're just going to walk you through one of these bars. If you look, you'll see this represents all of the different globally diversified equity and real estate asset classes. And if we start on the very far left-hand side at the far left-hand bar, you'll see that this bar represents the US large cap value asset class. And you can see that 15 years ago, there were 1,006 US large cap value managers in existence. At the end of that 15-year time period, the fund that we use for large cap value exposure, the Dimensional Fund Advisors US Large Cap Value Fund, finished that 15-year period ranked number 24 out of those 1,006 managers. What becomes really important, though, as you look at this data, if you look at the bar here, the bar is representing all 1,006 of those managers stacked based on performance. Now, at the bottom half, you'll see this grayed out area. And this bottom roughly half of all managers are managers that do not any longer exist, meaning at some point in time in that 15-year time period, they went out of business. Above that grayed out area, you'll see sort of a teal blue area here. And these are the managers that did finish the 15-year period, meaning they're still in business, okay? But they underperformed. You'll see the black line at the top here. This is the placement of the dimensional fund, or the fund that our clients own. In the center there, you'll see a white dot. Okay, and the white dot represents the placement of the index fund. So across the board here, across every asset class, you'll see that what we've been telling people for some time, and that is index funds tend to be better performing over the long term than almost all active managers. However, what you'll also see when you look at the black lines is that across every asset class, the funds that we use do outperform the majority of all active managers, as well as index funds themselves. Some people do ask, why is there no white dot in these middle two bars? Those middle two bars don't have a white dot because there was no index fund in existence 15 years ago that tracked those asset classes. So I think the key takeaway from this slide is, yes, we have short-term performance issues just like we did last year where markets are negative, right? No question about it. That happens from time to time. Over the long term, whether we're looking at 10-year, 15-year, or even greater than 15-year periods, right, we expect to have very nice performance. So what we wanted to give you an idea of is what has been the performance of these premiums over the very long term. Matt talked about 1, 5, and 10-year performance. I just showed you 15-year performance, but what have these actually looked like since inception? So if you go back and look at the small cap premium, right? And this is the small cap premium is an investor's decision to own small cap equities because we know over time, small cap stocks outperform large cap stocks. And if you look at one of the funds we use for small cap exposure, the DFA Micro Cap Fund, that fund was originated 37 years ago. So it's been in existence for 37 years. And as you can see on the far right-hand side here, showing you longer-term performance than we already have, that fund has noticeably outperformed its benchmark index for the 20, 25, 30, and 35-year period. And over the 35-year period, it's compounded at 1.25% per year for 35 years greater than its benchmark index. Now, I would point out to you that that's not 1.25% more than an index fund. That's 1.25% more than the index. If you owned an index fund, you'd have to pay an expense ratio to whatever company was managing it, and that would certainly add at least another 1/4 point to that outperformance. Now, a lot of the times people look at 1% a year and they say, boy, that's really not that big of a deal, right? Compounding at 1.25% a year over 37 years, that's probably not that much. So what we're showing you on the graph on the left is if you'd actually looked at investing $1 in each of those 37 years ago, right? You can see that the DFA funds 1.25% a year compounding would have actually ended roughly 37 years later with 65% more dollars. So it gives you an idea of how important compounding is over the long term, and how even small percentages compounded over the long term make up a really big deal. Then about a decade later came the value premium, right? And what we wanted to give you an idea in these next two slides is, what has DFA's ability to capture the value premium looked like? So in effect, what has been their delta in capturing the value premium versus the value index itself? And you can see here in the US large cap equity market, again, on the right-hand side, you can see across the 10, 15, 20, and 25-year timeframes that the fund has consistently outperformed its benchmark index. And over the last 25 years, it's outperformed by a little more than 0.5% a year. Again, you'd have to maybe add about another 0.25% to that if you were comparing it to an actual index fund to take account for the index fund's expense ratio. And in the small cap space, their ability to capture that value premium when looking at small cap stocks, again, the same thing when you look on the far right-hand side, over 1% a year and about 1.36% every year over the last 25 years, resulting in a dollar amount difference of almost 40% in dollars over that same time period.
So we mentioned earlier we'd be talking about 2018 and hopefully putting that year into context for you. 2018 wasn't a great year, but when you compare it to other years over the long term, it wasn't as uncommon as you might think. What was more uncommon was the lack of volatility we had in 2017. So some of you may have seen this graph before, but what it does is it illustrates volatility over the past roughly 40 years for US stocks. If you look at the far right-hand side of the screen, you'll see calendar year 2018. Now the red line shows the intra-year decline, which is measured by the percentage that stocks retreated from their highest point in that calendar year. If you look at the entire spectrum of years, you can see 2018's intra-year decline was not at all out of the ordinary. What was out of the ordinary was 2017's intra-year decline right next to it. 2017 was the first year in history that US stocks closed higher every single month. And as a result, we saw virtually no downward volatility. On the flip side, if you look at the intra-year gain, which would be the percentage stocks increased from their lowest point in that calendar year, you'll also see that 2018 wasn't out of the ordinary by any means. I would make the note that while calendar year volatility was not uncommon in 2018, how quickly it came in the latter stages of Q4 last year was a bit unusual, with most of the decline coming in December. And then finally on this chart, the blue highlighted part is the calendar year return. And you can see 2018 calendar year return was indeed negative for US stocks. So now I'll turn it over to Katie to provide additional context around volatility and specifically comparing 2017 to 2018.
Yeah, thanks, Matt. Matt did a really good job at setting us up here. And we're going to take all that information that he just went over, and we're going to dive even deeper into that same information. And the reason why we're spending so much time showing you the comparison year over here is because both of these years were so unique, but for very different reasons. In both years, things happened in the markets that were surprising for us. We'll take a look at a comparison for the years so you can just see how truly different they were side to side. Before we do that, let's set the stage one more time. 2017, like Matt said, was an anomaly. It's the only year on record that S&P 500 closed each month with gains. There was no monthly loss in 2017. That's never happened before. It was hard to lose money in 2017. Portfolios saw significantly above average gains. Then came 2018, starting off a bit normal with some volatility and then some nice gradual gains over the summer. But then Q4 hit and all bets were off. The S&P finished the year down over 6%, with almost all of that decline coming in the months of November and December. Santa did not show up in the markets this past December. So this is all important again because the difference between 2017 and 2018 was dramatic. And what made it even feel more dramatic was most of the decline in 2018 happened very fast and at the end of the year. In fact, December 2018 was the worst performing month for the S&P in 87 years. So recency bias in our minds definitely plays a role with our emotions. We remember what just happened and not necessarily back to 9, 12, or 18 months ago. So hopefully this comparison will help put the 2 years into perspective again, and you'll see that 2018 was maybe not as bad as it felt, but compared to 2017, it probably felt very severe. So in this slide, we're going to go through the comparison. Notice 2017 is in green and 2018 is in gold. So like Matt said, max intra-year decline was a difference of 2.8% in 2017, and in 2018, it was 19.8%. Average intra-year decline is 14%, so that felt really volatile. In 2017, the worst quarterly return was 3.1%, and in 2018, Matt, can you hit me? In 2018, negative 13.5%. So no quarterly deficit at all in 2017, but the worst in 2018 was 13.5%. Down months in 2017, 0 versus 4 in 2018. We saw a difference of 1% or more in 9 days in 2017, but in 2018, we saw it in 69 days. And then even more dramatically, a difference of 2% or more, either positive or negative, in just 1 day. We saw 0 of those days in 2017, but in 2018, we saw 21 days. So the annualized volatility for 2017 was 6.6%, and in 2018, it was 17.1%. The historical average was approximately 19%. So you can see, again, the real takeaway here was 2017 was an anomaly. 2018 was definitely unexpected, but it wasn't unprecedented. All right, so let's move on to the next slide. It's 2018 volatility and context, and Matt's going to take us through this slide.
Thanks, Katie. This is a busy graph, so just stick with me here for a second. This graph is showing the worst quarterly drawdowns or declines by U.S. stocks over the last roughly 50 years in the market. And what it's showing is how markets perform subsequent to those declines. So for the purpose of explaining this graph, let's look at the far left bar graphs, which represent Q3 of 1974. The green bar shows U.S. stocks declined roughly 25% during that quarter. Subsequently, over the next 12 months, which is represented by the blue bar, U.S. stocks returned just shy of 40%. And last, the yellow bar represents the annualized 24-month return subsequent to that quarterly decline, and in this instance was roughly 35% on an annualized basis. Now you'll see Q4 of last year circled in green in the middle of this page. And while we don't know what will happen over the next 12 and 24 months, we do observe a general trend of positive performance following these large quarterly declines. So what does this all mean? As it relates to volatility, contrary to what some believe and most people feel right now, 2017 was the real outlier relative to historic averages, not 2018. We talk more and more about behavioral biases and how they can influence our decision-making in both life and in investing. Katie mentioned recency bias. Recency bias is one we've spent a lot of time talking about with clients over the last year, and how it's easy to forget what happened in the positive years prior to 2018 and only focus on the recent past. But it's important to have that longer-term context. 2018 was a year where we experienced downward volatility that's common in equity markets. And really, it was a wake-up call to many investors that you don't get something for nothing. There's short-term risk in equity investing, and that materialized last year. With that being said, one of the cornerstones of our philosophy at Aspen Capital Management is having a long-term disciplined plan and not reacting to that short-term noise. There's no available data that suggests anyone can reliably and consistently profit from short-term investment decisions.
Okay, so I think we're going to go to a question now. Remember, if you have a question, please feel free to just type that into the chat, and we'll get to it either in the middle of the presentation, or we'll save most questions till the end as well. So here's an interesting question, Matt. Maybe you can help us answer it. We understand, the question came in, and this is what it says. We understand that 2018 was not unprecedented. However, it felt dramatic to us because of our age. At what point or what age do we make the decision to change our asset allocation?
Yeah, that's a great question. Asset allocation and the risk you're willing to take in your portfolio is an incredibly personal decision. We've got young clients that have conservative portfolios, and we've got older clients with more aggressive portfolios. So it really comes down to your personal comfort and tolerance for risk. Everyone's a little bit different, and that's a unique decision to them. When it comes to volatility and how it relates to your asset allocation, though, we want changes in that allocation to be personal and life-driven, not market-driven. If you think about it, the least optimal time to take less risk in the portfolio is typically following a market decline. But at the end of the day, if you're thinking about your asset allocation, that's something we'd love to know about and have a conversation with you. All right, so I'm going to try to put a little bit of a positive spin on the correction we experienced in Q4 last year, because when you look at what that decline in asset values did in combination with strong corporate profit growth, what they did to market valuations, it paints a rosier picture going forward than we had just 12 months ago. Again, another busy slide here. But we've told you before that current valuations are the best predictor of future returns. Not short-term future returns, but long-term future returns. Current valuations don't tell us anything about what's going to happen this year or next year or even 3 years from now. But they can tell us a lot about what's going to happen over longer term time periods, 7, 10, 15, 20 years. So intuitively, the lower the current valuation, the higher we expect future long-term returns to be. Now, this is an interesting chart that shows valuations over time, as measured by the forward price to earnings ratio. And as we go through this, it doesn't matter which valuation metric you'd be using, whether it's price to earnings, price to book, or other valuation metrics. You can see in the middle of the graph with the green dotted line that the 25-year average forward price to earnings ratio for US stocks has been 16.1. Following asset value declines last year and strong corporate profit growth, US stocks have gone from above long-term average valuations to below long-term average valuations, with a current forward price to earnings ratio of 14.4. One other interesting data point on this chart is if you look at February of last year, when we were having this exact same webinar, which that time period is represented by that yellow dot there. And at that time, we told you that US stocks were expensive relative to their historic average. And from that point on, we expected lower than average returns over the next decade. But you can see what a difference just a year makes in valuations. And going forward, the evidence would suggest that US stocks should be more in line with their historic averages over the very long term. Again, not this year or the short term, but over the very long term.
So as Matt mentioned, we had two things happening last year that I think in some respects are somewhat unreported in the media. Everybody knows that stock prices declined last year. But what people don't always understand is the absolute explosion we had in corporate profit growth last year due to the tax cut put into place 2 years ago on corporate profits. So when profits soar and prices decline, as Matt walked you through, that creates a compression in earnings valuations and that valuation multiple. What we wanted to give you an idea of here, though, is how dangerous it is to try to use current market valuations to predict short-term movements in the market. So on the graph we have up here, across the horizontal axis, we're plotting price to earnings ratio multiples. Okay, so on the left, you can see that's a time period when stocks were trading at 8 times earnings. And on the very far right, you can see that's a time period when stocks were trading at 23 times forward earnings estimates on the S&P 500. The vertical axis then shows you what is the subsequent or the next 1 year return for the S&P 500 when it's trading at those different earnings multiples. So the yellow dot you'll see again is where were we this time last year. So at this time last year, the S&P 500 was trading at about 19 times earnings. It was definitely on the more expensive side as we walked you through last year. And as you can see, earnings were below, they were actually negative for the year. But what you get an idea of when you look at this chart is you can tell that regardless of what the valuation level is, future 1 year earnings, future 1 year returns are completely random. If stocks are expensive on an earnings basis, you can have really good returns or you can have strongly negative returns. Similarly, you can see today's current valuation multiple of about 14.5 times earnings. You can see historically the spread in 1 year returns when stocks are valued the way they are today range from wildly positive up around 50% to wildly negative, down around 40%. And this is something, and this is why we always guide people. Unfortunately, the news media, whether you're reading the newspaper or you're turning on business news, you've always got people on TV that are trying to encourage you to make an investment decision based on today's valuations. And what this gives you an idea of is that's an absolute fool's game. Right? Today's valuations tell you almost nothing about what's going to happen in the short term. However, if you look out 5 years, okay, so this is what the graph on the right is showing you is if we look out 5 years and we look at current valuation multiples and what are their subsequent 5-year returns, not 1 year returns, but 5-year returns, you start to see that there actually becomes a reasonably strong correlation between current market valuations and 5-year returns. And in fact, the data that we've seen over the last couple of decades shows that the strongest correlation between current market valuations is 7-year returns, right? So as Matt said, market valuations tell us very little about what's going to happen in the short term. They actually tell us quite a bit about what's going to happen over the longer term. So again, if you look at where we exited last year, the reason in this webinar last year we were guiding people to based on current market valuations a year ago, again where the yellow dot is here, we knew that future expected returns over the 5 to 10 year period were likely going to be below historic average. So the silver lining in the market pullback of December is it moved valuations to the left, where you can see they're currently trading at about 14.5 times earnings, and put us in a position where from here, return expectations over the next 5 to 10 years look much more like historic long-term averages than they did a year ago. Now, everything we were talking about in that last slide was U.S. or the S&P 500, so U.S. large cap equity valuations. The graph on the right here is intended to give you a more global perspective. So you will see the vertical bar on the left does represent the U.S. market, okay? What this is plotting for you is you'll see that the blue diamond represents the current market valuation, and the purple horizontal bar represents the 25-year average valuation. So the bar just to the right of the United States is international developed markets. Okay, think of that as Western Europe, Canada, Australia, Japan. And then on the far right, you'll see emerging markets. And as Matt mentioned earlier, most people usually think of that as the BRIC countries, Brazil, Russia, India, China. And what you see is, regardless of where you look in the world, valuations today are slightly below their historic long-term averages. Again, while this tells us virtually nothing about what we should expect in the short term, it does make us feel better that return expectations over that 5 to 10 year time period from global equities should be reasonably in line with their historic averages. Now that was equities. Let's talk about bonds. But before I talk about bonds, I know that valuations and future return expectations are always a topic that brings up a lot of questions. So again, if you want to just pull your mouse down to the bottom, there will be a menu that will show up. There will be a chat icon there. And if you click on that chat icon, you can submit an anonymous question to us. But let's talk for a minute about bonds and fixed income. And bonds are very different than equities. We just got through spending 10 minutes explaining to you how on equities, we really have no accuracy at all in predicting short-term or returns with equities. We do have an idea of what longer-term returns with equities should look like. On the bond side, we actually know a lot about what future expected returns should be in fixed income or in the bond markets. Historically, we know that over the next decade, there's about a 90% correlation historically with future 10-year returns in the bond market and the current yield on the 10-year treasury. So the current yield on the 10-year treasury is about 2.75%. And so for a high credit quality fixed income portfolio, we would expect that returns over the next decade would likely be, we've got about a 90% degree of confidence that those returns will be somewhere between 2.5% and 3% a year. If somebody was taking more duration risk or more credit risk, they could possibly be a bit higher than that. But for a moderate duration, high credit quality bond portfolio, like our clients tend to own, this would be the expectation as we go forward. Most importantly, as if you've been a long-time client, you know that we try to guide you to really focus on what you can control. All this data is interesting. What we want to do is guide you to keep it from encouraging you to make short-term emotional decisions. So if we look at what can't we control, right? As we just walked through, we can't pick winning stocks. We know nobody's been able to do that over time, right? We can't time the markets, and we certainly can't trust the financial press to give us good investment advice. What we can control is we can control how much risk we take through asset allocation and proper global diversification. We have a lot of control over how much risk we do take and how much volatility we experience in periods like November and December of last year. Likewise, we can reduce our expenses, right? So the asset managers that we use, all of their expense ratios are in the bottom decile of all fund managers by their asset class. And similarly, our own expenses as financial advisors are below industry average across virtually every size portfolio. We can also minimize taxes through things like proper asset location. Minimizing taxes is absolutely something we can control. And we can certainly control our own discipline and make sure that we've got a financial plan with a withdrawal strategy that's going to allow you to maintain your standard of living over time. So most importantly, we want to make sure that you're focusing on things that you can control, not things that you can't control.
All right. Great. Thanks, Mike. I just want to interrupt for a moment because we have another question, and I thought that this would be a good one for you to maybe take a minute to answer. So the question came in: what impact do you believe the current political climate and the upcoming election will have on the markets? Do you want to try to answer that one for us?
Yeah, that's a great question, and it's certainly one that I think we've received quite frequently, really over the last 12 to 18 months, and I think it got heightened with the volatility in December. I think we would break this up into short term and long term. I think we've all seen and experienced over the short term that the current level of noise that we tend to see in the markets does, I think, is in fact exacerbated by the political environment and the use of social media, right? The use of social media and the information that's shared certainly does, I think, increase our short-term day-to-day volatility. I think we see that, and I don't think anyone could probably rationally argue that doesn't happen. We're not short-term performers. We're not short-term investors. I think if you were a day trader, that would probably be very valuable to you. We're not day traders. We're long-term disciplined investors. And I think certainly over time, what we see is stock prices are a reflection of investors' expectations of future profits. And so while we will experience day-to-day machinations based on what's showing up on social media, I don't think that has much impact at all on long-term returns. So the last thing we wanted to cover here was a question that we get a lot from people, and especially people that are wanting to retire early. I'd say it breaks into two camps. People that are wanting to retire early or earlier in life want to feel for what are their healthcare expenses going to look like. And certainly folks that are in retirement, they want to get a good sense of what expenses might they have in retirement, and especially in sort of assisted or long-term care living. So we wanted to walk you through just our experience and our research and what we've learned on this topic.
Great. So yeah, we're going to take you through a timeline. We hear a lot of questions around healthcare and how to plan and the cost of healthcare, and we're hoping this just gives you kind of an idea of what you can expect and gives you some tools for planning to your own retirement or even in the future. So I kind of wanted to start with a story about my mom. So my mom was a teacher for 40 years. She retired after 40 years. And after she retired, she had an amount in her mind of what her pension would be. And she had budgeted to this pension, and she knew that she was going to have to get some private insurance because she was retiring at 63. So for a couple of years, she'd have to pay for private insurance. And she budgeted an amount, but she didn't do a lot of research behind it. So when the time actually came and she retired and then had to actually go and find the private insurance, it came back way more expensive than she ever thought that it would be. And her take-home pay after paying for that insurance was 40% less than what she was budgeting for. So I think that's an important story because it's an interesting case study in how much different that private insurance can be, or what a surprise it can be for people that didn't realize it was coming. And it can have an impact on the age that you decide to retire. So for private insurance and pre-Medicare, ages 55 to 64, you can expect about $1,200 to $1,600 a month for a couple, and that's aged about 60 is where we came up with that estimation. So again, for a couple, age 60. Next, after Medicare actually comes through, so after age 65 or at age 65, the cost doesn't go away, but it does reduce pretty significantly. However, what you want to keep in mind is you have your Medicare premiums, but we highly recommend also paying for supplemental Medicare costs. So you've got your Medicare premium, which is going to be estimated estimated at $270 per month to $920 per month. Now, that cost is income dependent. And for most of our clients, we found that they're on the lower end of the spectrum. However, we wanted to put that because it can be quite different depending on how much income you have coming in. And those estimations are for a couple as well. Now, supplemental will be in addition to that, and supplemental insurance will be really great to have because it will really keep your out-of-pocket costs lower. And those you can budget around $300 to $800 a month for a couple as well. Now, something else we just want to mention is are to be aware of the things that are not actually covered by Medicare or supplemental insurance. And those are things like dental or hearing, and that's not typically, again, covered by Medicare. So what we see in financial planning with our clients, most of our clients are not planning or haven't added into their budgets the idea of maybe a tooth replacement that could be around $4,000, or even a hearing aid that could be approximately, $5,000. So those types of things that are not covered can be quite expensive and can be big gotcha moments when it comes to your financial plan and your yearly budgeting. So just keep that in mind. Hopefully that gives you an idea for the kind of 55 through Medicare and beyond. And Matt's going to kind of take us through insurance and what we can expect for later in life.
So the latter stages of life, sometimes, not always, but sometimes includes assisted or independent living for those that choose to move into a facility of some kind. Everyone has their own thoughts or opinions on independent and assisted living. Personally, I am very excited for independent living. I've got a few years until eligibility, but sounds like a good deal. People cook your meals. There's gin rummy tournaments. Some people have putt-putt golf. Super Bowl party here coming up. Go Pats. So I think it sounds like a sweet deal, but it's certainly not for everybody. There are many different ways that both assisted living services and assisted living costs can be structured. Some require a large down payment with lower monthly payments after that. Some require no down payment with larger monthly payments. But what we did here is we just took the average cost for 4 different cities on the West Coast and Pacific Northwest. And you can see Boise being the most inexpensive assisted living option at $3,500 a month, and both San Francisco and Seattle being the most expensive option at $5,750 per month. Take that one step further. In the last couple years of someone's life, quite a few people do tend to graduate to more involved care, like nursing care. This is more round-the-clock type care, and as such, you can see the increased costs for the various cities that we've listed here. While the increase in monthly costs is substantial, the research shows that people don't tend to spend a long time in nursing care. And we don't have the data up here on the slides, but the data that I've seen in the past is that the average nursing care stint for males is just over a year, and it's just shy of 1.5 years for females. So again, while the cost may seem like a lot, and it is, the chance of someone pays that ongoing cost for a number of years is statistically quite low. So with that, I'll turn it back over to Mike to wrap this up.
So again, if you do have any questions, please do, again, take your mouse to the bottom, find the chat bar and enter the questions there. We did, I believe, have one more question. It appears that Dan wants to know if the Boise assisted living number is using the spare bedroom at my house. I haven't had a long time to think through this, but I would probably be willing to give you a cut rate on that. $3,500 a month in Boise. Dan, I would be happy to rent you my spare bedroom for $3,000 a month rather than $3,500. No meals included. You've got $500 to spend as you wish on meals. One thing actually that is worth pointing out, we did have a question about the assisted living numbers and are they for an individual or for a couple? And one thing to remember with both independent living and assisted living is that you do benefit from having a couple in either of those. You get some economies of scale, because in both independent living and assisted living, you tend to just be you're renting a room, and you're paying for that room whether it's one person or two people. So the cost of the second person is not 2x. It does tend to be a small multiplier, basically to cover the additional costs of food and whatnot. So you do get some benefits of having a second person there that you don't get in nursing care. Those numbers for nursing care, if it's one person, it's going to be about 9,000, and if it's two people, it's going to be 18,000. You don't really get economies of scale there. So with that said, it doesn't look like we have any more questions. We will certainly be uploading a recorded version of this to our website. You'll be getting an email from us. If you've got a family member or a friend that you think would benefit from any of this information, please forward them that email. They're welcome to go to our website and listen to this at their leisure anytime they want to. And in addition, if you're interested in getting more information like we shared today, we're regularly posting articles and research and information that we think our clients would enjoy reading on our Aspen Capital Management Facebook page. So if you just go to Facebook, search for Aspen Capital Management, and you like our page, we will show up from time to time in your feed on Facebook. So with that, we thank you for joining us this morning. It does look like maybe we have one more question. We're happy to hang on board and answer questions. It doesn't look like it was a question. It was just a comment. We appreciate you guys taking the time to join us this morning. And if you do have any follow-up questions for any of us, you're welcome to give us a call or shoot us an email as you think about this information. If anything comes up, that's what we're here for. Have a great day. Thank you.